Let me speak to Dr. Ndemo, who is with me, Professor of Entrepreneurship. Dr. when is the right moment to, get or start looking for funding of any kind, be it a loan, be it venture capital, be it an angel investor? At what point should we be seeking funding, and what sort of funding should we be seeking at the different stages?
Different types of funds that you can access in the market. As I said, if it is an idea that you have solved a major problem in society, then you can go for the venture capital, where they invest in the shares in return of the shares. But if it is something smaller, then you need to borrow just adequate to enable you to do business. That, like we said, if you are an SME, for example, you don't borrow more than you need, because you are going to pay interest in the money that you borrow. So you need to figure out the precise amount of resources that you need. But even before you go into the banks, sometimes various organizations get advice to finance before they can borrow. For example, if you negotiate with the people you are supplying with to pay you up front, that is financing. If you negotiate to delay your payables, that is financing. So people need to understand what other mechanisms that are available to them by critically analyzing their financial requirements, and then sitting down to understand precisely what do I need in terms of borrowing. Can I fund through receivables? Can I fund through payables? So that by simple delay. But most people, and you can see from those who used to supply the supermarkets that failed, because those supermarkets did not pay many of the suppliers, and they ended up losing their entire resources. So if you are a small SME, you don't go for companies, you don't work with the companies that are too powerful, that they can negotiate 6 months before they can pay you. When they negotiate 6 months, they will kill you, because you will not have enough resources to do business. So you would rather do smaller supply to smaller, those who can buy from you in small quantities, but you have a cash flow, than going for big, and then you collapse, or it collapses because they have too much power. They negotiate better deals for them by financing themselves from your resources. So those are all financing mechanisms, but people just think that financing is walking to the bank and the bank gives you the money. The bank gives you the money and they will charge you instantly from the time you take the money. That is why the lending platforms have come in handy for mamambogas, where they can borrow very early in the morning, they are able to refund in the evening, they minimize the cost of finance, and they grow their enterprises. So
Yeah, Dr. Ndemo, just to pick up on that, you do have some thoughts about women-led versus men-led businesses when it comes to how they handle debt and financing, particularly even from the digital lenders. Could you talk to us about, the observations that have been seen, trends that have been observed as well?
The trend we see, women, almost 98% of the women borrowers, they fund the money. A huge number of men-run enterprises, they default, especially those borrowing from the lending platforms and other lending like Mshwari and others. Men are sometimes vulnerable to, say, for example, gambling. Whatever money they get, they take it there. They think they will make more money to pay the bank, and then they fail. If you look at the list of those who are in those who are forgiven by the governor, those who are in the credit reference bureaus, they are mostly men, and that in the future probably would become a problem because they will probably focus more on women. Maybe you can ask the bank to tell you who are the most trustworthy customers with respect to gender. I think they will give you the same answer.
Okay. She's right here.
I agree totally. Just from statistics and from what we are seeing in the bank, we have a higher non-performing loan book for businesses that are led, maybe I should say men and generally mixed businesses. But for businesses that are led by women or they are owned by women, their default rates are much lower. We have a women's program, a women's proposition, and of that book we have disbursed loans of almost 27 billion, and the performance of that book stands at below 3% compared to the regular book, which is almost at 13%. So you can, it's true, women do pay for their for whatever they owe to whoever it is, not just the banks. They take time to ensure that they pay, and they only borrow if it is going to add value to either their family or to their business. They will not just borrow randomly.
Mm-hmm. Yeah. And something I've heard both you and Dr. Ndemo saying, and you said it a little earlier, borrow only for what you need. Yes. Don't ask for more than you will, because whichever way you will be paying it back. If it's a venture capital, if you ask for more, then you're definitely going to give more in terms of equity in your business. And so you'll be doing that for something that doesn't quite give value to the business. Linda, the legal loopholes that exist when one is looking for funding, financing of whatever kind, it could be a loan. Tell us about the fine print and some of the challenges that we have, or mistakes that startups and SMEs make with respect to that. And also with venture capital, how do you make that decision as to how much equity to give away? Like you said, it's 100,000. Am I giving away 10%? And we'll talk about the soul of the business with Dr. Ndemo in a moment. But what are some of the legal challenges you've seen?
I think I'll pick up from what she said about knowing what you need the funding for, and so really determining whether you need it or not. So one, if you're at seed stage and you want a product market fit, you simply just want to indicate that this product actually works, help us to go to this market. You don't need too much money. So don't raise too much money when you don't need it at that particular point. And two, one of the things that happens is people don't know how much to give away. And so they would come into a lawyer and say, please process this transaction. I'm giving them 60% of my company. You cannot give 60% of your company at seed stage. So you need to research and find out what's the market like. And so at seed stage, I typically give 10%. In the US, mostly they would give you $100,000. That's about 10 million Kenya shillings. And so knowing which investor is right for which stage then allows you to know how much you're actually going to give away. So please don't give out your entire organization just because somebody give you $1 million shillings. It's not wise. So now two, about the legal loopholes, I think we don't read the fine print, whether it's from a bank or it's from venture capital. So if you're given a term sheet by a VC firm, you need to go through the term sheet and say, okay, this is what we are giving away. Understand what you're giving away, and then please do your research with other startups that have raised, so that you know that at this particular stage we're giving 20% for maybe $100 million. Just today, I think there's a Nigerian firm, I think, that has raised 100 million USD, which if I got to disappear, you'd never see me again. But just understanding exactly, are we at seed stage, are we at growth stage, are we at expansion? If you're at growth stage, you're looking at that's sort of funding that will help you dominate Kenya. And so what do you need to dominate this country? If you're looking at expansion, you're looking at institutional investors that will maybe help you scale across the continent in that particular sense. So I think that's where we lose it. And so VC firms will give you, a venture capital firm will actually give you situations you can't even, they give you goals you can't ideally deliver. And so don't get to that point, because people say VC funding and even banks, it's like that problem that you want to avoid but can't avoid. So please try and avoid them. They say this about capital, and I advise people, the most important person who can give you money is users. So like Professor Bitangi Ndemo said, sell to real users. That when they give you money, you actually reinvest back to the company. That's the best way to grow a business. But we know you can't grow fast as a startup without external funding. So, and then two, I think what needs to happen is look at the governance within the term sheet you have, or with whatever loan that you're getting. What are they saying about a board seat? For instance, somebody will bring in the capital and say, we're going to run 70% of the board. If they're running 70% of the board, they can fire the CEO. Maybe you're the CEO and your founder. They will fire you. And we've seen this within the tech ecosystem. Steve Jobs was fired from his own company that he founded.
Yes.
And so it's possible to be kicked out of your own company. You need to look at the fine print. You also need to look at, you know, who is this investor that's coming? What are they bringing? Is it just money alone? Are they bringing talent? Are they bringing advice? And that can only be quantified by looking at the term sheet that you have ahead of you. And sometimes people give us promises, like banks, even when you're negotiating, they tell you, kitu utalipa tu vile unataka. You know, like a salesperson will pitch and tell you, hata ukichelewa hakuna shida. No, it's what's on the final document that you must go through.
Sign on.
That's the one that you're going to sign. And if you can, sign on every page. Don't just sign at the back and say, they told me to sign here. Try and sign on each and every page and say, I did not actually agree to this particular page. That would help you to even renegotiate. And I think one of the things that people don't do is to renegotiate these things. The fact that it's been printed doesn't mean it can be changed. Renegotiate and tell them, no, I don't agree with this. Could you consider doing this and this? What about
and even contingencies you would need in the event you're unable to pay back? That's also important to take a look at.
And if there's a pandemic, what happens to, you know, in the case of a pandemic, what's going to happen to you? So those particular, I think, nitty-gritties, you need to read about them and also know what happens to your co-founder. Everyone else that you began the business with, don't age them out, because you have other agreements that came before. The people also hired people. When you hire and you're not able to pay them in the beginning, we have people who actually issue equity to early employees. So you need to know, even if I'm raising, what happens to the early employees, to their shares? What happens during this dilution of shares?
Absolutely.